All right, it's all over the news. The Fed has cut the Fed rate by 50 basis points. And everywhere you look today, this is what you're seeing. You're seeing huge headlines basically announcing this fact. Everybody's talking about it. We're already getting calls about, oh my gosh, mortgage interest rates must have dropped so much. I mean, after all, take a look at this. We've been waiting for so long for this to happen. And so this is what we're seeing. In fact, we even see, hey, here, how's it going to affect mortgages? And so there's a lot of discussion about whether or not it's going to have a big effect on mortgage rates. Here's what's interesting. Yesterday, mortgage interest rates actually went up. So this is actual the actual data on where mortgage interest rates come from. This is mortgage-backed securities. They're bonds. They trade much the way that stocks do, and this is what lenders will price their rates on every single day. It's the reason why mortgage interest rate pricing changes daily, and on volatile days like this, you'll actually see pricing change multiple times per day. And if you're looking at this and you're wondering, what the heck does this even look like? So we have a stock chart, and green is good. Green means that interest rates are coming down or becoming less expensive. Red is obviously the exact opposite of that. This was yesterday, the day that the Fed cut the rate by 50 basis points. And actually, what happened is that mortgage interest rates went up a little bit. Now, why? Why did that happen? Well, if you notice, we've actually been seeing mortgage interest rates come down for a long period of time at this point, a couple of months. Now, the reason being is that mortgage interest rates are not directly connected to the Fed rate. They're actual bonds, and they move inversely to the 10-year Treasury yield. So the 10-year Treasury, as this has been coming down, as you can see here, which now is actually coming up, as this comes down, typically you're going to see mortgage interest rates actually do the same. They're actually going to come down because mortgage-backed securities are going up in value. Now, to give you some idea of what this has looked like over the last 2 years, right now, where you see this, this is where we had mortgage interest rates that were in the eights. We had a really strong recovery that faltered a little bit. This is where we found that inflation was stickier than we expected. And then we've had a really strong recovery as we've seen the economic data cooling, showing that inflation is coming under control and expecting the Fed to cut rate in the future. So essentially, everything that the Fed did yesterday has already been baked into where mortgage rates are at. So we're not expecting it to actually make a huge move otherwise. We currently have the best pricing since we have seen since all the way back to February of 2023. That's significant. Now, if you're wondering what rates are going to do in the near future, here's what's going on. And this seems like a rather lackluster response compared to what the Fed did yesterday, which was significant. The reason being is this: the Fed cut by 50 basis points. The likelihood that they're going to cut by 50 basis points again is really small. In fact, they said yesterday, don't get used to it. It's going to probably be cuts of 25 basis points in the future. And so what that means is there's not as much to look forward to or be excited about. And so you're going to have traders that are essentially locking in their profits now. And that means that we're not making a huge steps forward. I do expect that the trend will likely continue in having rates come down, but ultimately it's not a huge hit to mortgage interest rates as far as them coming down simply because the Fed cut rate. Now, if the Fed indicates that they're going to cut rates more aggressively based upon future economic reports coming out, then that may have another effect in really driving rates down further. But this is one of the reasons why we are likely going to see rates continue to fall, but on a more slower pace, most likely over the next 1 to 2 years, if we continue to show that inflation is where it needs to be. Inflation could move opposite and surprise us all. In that situation, you're going to see mortgage interest rates rise, which is one of the reasons why, if you have not done a refinance and you have interest rates that are in the sixes, sevens, eights, reach out to us today, because that is a situation where we want to make sure that we are moving your rate down so that in case rates go back up, you're not stuck in a high interest rate payment. Thanks a lot. We'll talk to you soon.